Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 147th VideoCast, 137th podcast for the week ending Wednesday, August 10th, 2022. We're doing it early this week. I'm traveling out to see some friends in Montana tomorrow, taking the kids and my wife. It's going to be awesome. And next week will also be early. It will be on Wednesday because I've got some investors coming in, flying in from abroad, and meeting up with them. So with that said, I want to kick it off with the media spots, and we've got a lot of great stuff to cover on Cooper Standard. I'm sure you guys are waiting to hear about that. It's been a pretty exciting week. But first off, I would like to thank Charlotte Pesal of the Money Show for having me on. We went into extensive detail about our investing style, about our about special situations, about Cooper Standard, which we're going to embed a clip of that into this video cast because I went into really extensive detail on that. And then a history of a number of special situations we've done over the last decade and what was our reasoning going in, how they worked out, etc., how we adapted during the positions. So you can play the full thing on hedgefundtips.com. Just go down to featured on under categories right here, and you can play the full clip, which I think a lot of you will benefit from, but we don't have time for that all in this video cast. Also want to thank Mitch Hawk. I was on with him Monday on Benzinga, which is quite a large platform, and we always have a fun time talking. We were talking about what's going to happen with the inflation report, and I took the under, and he was a little surprised. It came out well this month, so we're really excited about that. We're going to talk all about inflation. We're also going to embed a clip from that into this video cast later on about the general economy, because he did ask about China. He asked about other places that we're investing. And as always, Mitch asks tremendous questions. So you'll hear that a little bit later. But if you want to hear the full thing, you can also hear it in the same place under featured on. And then this morning, I did for the first time the Indonesia Investment Forum. By the way, I want to thank Mitch Hawk and Zoltan Suranyi over at Benzingo for having me on. And then the Indonesia Investment Forum this morning was 2 hours. I spoke probably for about 45 minutes of that with another gentleman who's got $1 billion private equity fund in Jakarta. And, for those of you who are emerging market investors, Indonesia, for my money, will be the best place to invest for the next 10 years, followed by India. For sure, and we went through all the reasons why, all the companies, all the sectors, so it'll be the first time you're hearing that and the reasoning behind it. I strongly urge you to listen to that again under featured on. If you click here, it automatically fast forwards to the part where I start talking. If you want to see all the other speakers as well, just rewind it back to the beginning of the recording. So thanks to Christovita Willoto and Aline Wirit Maha. Aline, I've known Aline for a while. I did CNBC Indonesia a couple segments with her some time back. So it was really great to be interviewed by her once again, and very excited about that. I'll be on not CNBC Indonesia, CNBC Asia. It's the All of Asia morning show, 10 p.m. 10 p.m. Eastern time on Monday night when I get back. And then I guess that's 9 a.m. CNBC Asia time. So for those of you tuning in from Asia, that's probably your regular CNBC tune-in. Look forward to seeing you on that show. Thanks to Ginny for inviting me on. Moving right along, want to thank Lydia Moynihan for quoting me in my favorite newspaper, the New York Post. This was about the tax bill taxing buybacks, which would start 1% of buybacks. It will start in January 1st. I said we could see billions in buybacks accelerated before year end. We could wind up the year at much higher levels than most would have thought just a few weeks ago. Most, not us. We've been talking about this since June when everyone was puking on their shoes and dumping stocks and hedge funds that sold the most that week at the bottom. ever in history. And we said, guys, this is ridiculous. If you're not buying in here, find another business. And those of you who are regular followers will remember that exact quote. And here we are a few weeks later in a completely different situation. Okay, want to thank Samuel Shen and Z Wu for including me in the Reuters article about delisting. Quote, our base case is that authorities come to a resolution on U.S. listings and the status quo from the past 2 decades remains. Moving forward, Bansari Kamdar, thanks for including me on the inflation. I said, as expected, we finally saw a reprieve. This now brings the idea of a Fed pivot or slowdown in hikes back on the table after Friday's strong jobs report took it off. And I covered that with Mitch, so you're going to enjoy the segment. This was on Monday. I said, look, I think inflation is going to come in much better than expected. If you look at the Cleveland Fed numbers, right now, the pivot that we talked about last week is off the table because the jobs report was so strong. But if I'm right about Wednesday and inflation comes down, that means the Fed can start to slow hiking, if not pause altogether, certainly do less than 75 basis points and then pause from there in September. So that's all starting to play out. Also want to thank Bansari Kamdar. She asked why banks were up today. I said, investors are chasing the laggards that haven't participated in the huge runoff, the June lows. Banks have underperformed and now getting bid. Basically, what I said is managers are in too much cash, and now they have to chase the rally, and they don't want to chase what's up 30 and 40% off June while they were twiddling their thumbs. They want, like biotech is now up, I think, 45, 50% off the May lows, and just getting started in our view. It'll take a breather here just to knock out the Johnny-come-latelys, but the direction is up over the next year and a half. And that's the answer to that question. Also want to thank Davide Barbusia, Megan Davies, David Gaffin, Laura Sanicola, Saqib Ahmed, Sinud Karu, Susan Matthew, Akash Shriram, Aniruddha Ghosh, and Megan Davies for including me in their article on Reuters. This was about the tax. The number one thing that stands out is you're going to see an acceleration of buybacks before the end of this year. Companies would rather not pay the tax. They have this window, and you can be assured they're going to take advantage of it. Next, this was thanks to Bansari Kamdar and Aniruddha Ghosh about biotech. I said, all in all, it's a net positive. Biotech and pharma should rebound after some uncertainty because the bill is less onerous than initially anticipated as it relates to negotiating drug prices. It doesn't start until 2026. It's a dozen companies and then another 10 the year after. They can't negotiate prices in the first 13 years. So this is all off patent issues. And what that means is that drug companies are just going to raise prices the first 13 years. So unintended consequence of regulation. Thanks to Zero Hedge, Tyler Durden, that's not his real name, I know it is, for including me in Zero Hedge earlier last week. I just picked it up this week in Google Alert, but it was like a week and a half ago when everyone was bearish. And he quoted some of our stuff. Others, such as Thomas Hayes of Great Hill Capital, no one is positioned for any good news. Cash levels are the highest since 9/11. Recession fears are most pronounced since April 2020 and March 2009. The stock market is a discounting mechanism, so while we may be in or will have a recession, the market will bottom far before it is declared. Managers will have to chase up and panic buy any further unexpected strength. Well, they've been doing that the last 2 weeks and then some. Thanks to Bansari Kamdar and Aniruddha Ghosh again. Okay, we covered that one. And then the quote of the week is to buy when others are despondently selling and to sell when others are euphorically buying takes the greatest courage but provides the greatest profit. That's what we're doing, and we have the pleasure of talking about Cooper Standard this week. Up, it was up 70% off the earnings, and now it's up another 15-20%. I didn't look at it late today, but I know it's over $10. So we're cooking there, and that's our third largest position, which is exciting. Biotech is our second largest, which has now started to rebound, which we just covered. And Baba will get into the Masi-san overhang, I think is going to be in the rearview mirror shortly. But he's just selling on anything that's not nailed down because, he bet on things like WeWorks and he bought into the hype last year and bought the top and now he's paying the price, which is not characteristic for Masa. He's done some great deals over the years, but, he's a human being and he got caught up at the wrong time in the wrong way. But he's like a cat. He's got 9 lives. He'll be back. Bigger and better. The problem is he won't participate as much in the upside of Alibaba over the next year and a half. But world's smallest violin, he's still a billionaire and probably going to be many multiples more than that 10 years from now. Okay, inflation runs cooler than forecast, easing pressure on the Fed. So this is all good news. We saw this today. Here are the numbers. Core CPI came in at 0.3% versus 0.5% expected versus 0.7% gain last month. This is the month-on-month numbers. The year-on-year numbers were expected to come up. 6.1 was 5.9. But the big headline was the CPI month-on-month did not increase at all. It was zero, goose egg. It did not go up. Prices stopped going up. Year-on-year 8.5 versus 8.7 expectations, 9.1 last print, so it's starting to come down, etc. So that's that. While we've got this open, let's just take a look at any other major economic stuff we want to cover this week. China's CPI came in lower than expected. It was expected at 2.9. It was 2.7. That's up from 2.5. But the PPI came in much lower than expected, 4.8. It was at 4.2. That's a leading indicator, so that's positive there. Big build in crude inventories. That's positive. And that's the story on the economic data. Investors are betting there's a 60% chance of a smaller Fed rate hike in September after a July inflation cooled. We've been saying that for weeks. So now it's down to 41% of 75. I think it's 50 max. It could be 25. It could be 0 if we get another positive GDP print, which we were talking about last week. The jobs report was probably a little too hot for it to be 0. So I'm thinking 25, 50. But let's see what the data says over the next 6 weeks. The key is the pivot is from massive fire slaying to a more rational approach moving forward. And that implies a pivot when you're moving down from peak 75 to 50 or 25 or 0, and that's moving in the right direction. Tom Lee, history shows the bear market is almost over as the length of most declines are typically 21% of the prior bull run. Fundstrat says, so he's doing this on the basis of time. We're right at the median, and therefore he says statistically we're there. All you have to do is look at the market, and you kind of figured that out, but I always love reading his stuff. NASDAQ is on track to exit a bear market and the Dow to leave correction territory after the July CPI reading, so that's all good technical stuff. I put this out 5 days ago, so that must have been on Friday. This was Howard Marks on CNBC in the morning, and he was saying he made his whole career buying assets when they're deemed uninvestable, and that China was deemed that, and he sees opportunity in China. So you can click on my profile, Twitter profile at Hedge Fund Tips, and scroll down to find that video. It's 40 seconds, and he just lays it out. That one went viral, 370 likes, 60 retweets. People kind of like that one. I think I've covered this briefly, but it's the greatest value investor you've never heard of, the story of this guy, Floyd Odom. Basically, the story is he started with $40,000 in the 20s. He blew it up to 0. And so he went from being a trader to an investor, from a tape reader to a business analyst, from a lawyer to a Wall Street legend. And he started a partnership in 1923 with $39,000, which would be the equivalent of $500,000 today. Over the next 2 years, after he went from trading to investing, he got really grew that with new investors and returns to $660,000 and had a mind-numbing compound annual growth rate. Now, why is this important? He was a deep value investor. He searched after he made the mistake of being a speculator, chasing things at the top and chasing the herd like everyone did in 2021 and got smashed. He searched for 50-cent dollars and scoured every corner of the market. According to documents from the Eisenhower Library, Odlum preferred two kinds of investments: utility stocks and special situations. He defined a special situation, and this is important because this is what Cooper Standard is. This is what Range Resources was. This was what many of the things you're going to listen and watch in the Money Show. If you decide to watch the full thing, I've gone through a bunch of special situations we've done over the years. You're going to find valuable. But he defined it as an investment involving not only primary financial sponsorship, but also responsibility for the management of the enterprise. The former lawyer wasn't interested in flipping a business for a quick buck either. Strategy was the determination to see a special situation through until success. We will stay with the investment until the essentials of the job have been done and then move on to another special situation. Between 25 and 29, he grew the partnership, investing in utilities and special situations. The AUM grew from 6 million to over 88 million. That's over 88 million adjusted for inflation. Around the time he began sensing a euphoria in the market, he smelled the top and decided it was time to act. He went into cash, sold half of his assets, and with 14 million of cash, he sat on his hands waiting for the next market crash, which shortly followed. After the crash, Odlum looked around quietly with more money ready than most anybody on Wall Street, except a few of the big banks, and noticed that the trend in trust had reversed. He dabbled in industries including mining, oil and gas, motion picture, aircraft and airlines, department stores, all the stuff that would benefit from the turnaround, manufacturing, Broadway stage productions, hotels and buildings. But his bread and butter during the Depression was buying investment trusts. His strategy was simple. He found investment trusts that had fallen so much their stock prices were trading at less than the value of their marketable securities. A good example of this, blah, blah, blah. Okay. He discovered he could buy these trusts, liquidate their assets, and reap large profits for stakeholders. He was buying dollar bills for 60 cents. He milked this strategy for all it's worth. It's not dissimilar to what we did with Wells Fargo, what we did with Exxon, what we're doing right now with Alibaba and Cooper Standard in many senses. This strategy helped him grow his assets to 150 million, 2.2 billion adjusted for inflation. He grew his assets 384,000% in over a decade. That's a 32,000 CAGR for asset growth. That's raising and returns. But it goes to show that all these people chasing up these things when they're breaking out, or when everyone's excited, or when when they've already run up for 10 straight years and they're saying, wow, it's a quality business, because they look in the rearview mirror at the financials for 10 years, versus looking at a business that has been misappraised due to short-term exogenous temporary impairments, where you can make many multiples in a short period of time if you're patient and you can deal with the short-term volatility. And that's what we try to do here at Great Hill Capital, and that's what we've done since day one. So boring is beautiful. Be a dumpster diver. Let's see. These are boring corners of the market. Yeah, I mean, what could be more boring than window ceilings and fuel delivery systems? And be a dumpster diver. Oh, the stocks Odlum bought were the ones others hated. These companies traded around 52-week and all-time lows. Sounds familiar? You wouldn't find anyone talking about these stocks at cocktail parties. And yet they offered outsized returns simply because no one bothered to look at the potential hidden value. Be a dumpster diver with standards. You'll find many companies trading around all-time lows that aren't as bad as Mr. Market thinks. And we couldn't agree more. And we're seeing that start to play out. Speaking of dumpster diving, Alibaba says primary listing in Hong Kong is approved. That means by the end of the year, we'll start to get the Stock Connect flows of $20-30 billion like Tencent has had for all these years. I think that will be helpful. The question is, who's smart enough to front run the change? And we've certainly taken advantage of that. So we're very optimistic. The big issue is Masayoshi-san at SoftBank was chasing a bunch of garbage at WeWork and all this stuff during the pandemic excitement, and he was buying all these things up from DoorDash, etc. And now the triplet killers, ladies, liquor, and leverage. He got hit by the third one, which is leverage, and now he's got to sell everything that's not nailed down. He's selling Alibaba, he's selling SoftBank, and he's so reluctant to sell Alibaba because What he did was these prepaid forward contracts that gave him the right to continue to own the stock. But the problem is his ARM Holdings IPO got delayed in the UK, so now he needs to raise cash. He's still holding on to 14.6% from 23.7% ownership, but those contracts came due, which basically what he was doing was selling in the money call options, and he had to deliver the stock. He thought he was going to be able to buy back the options and keep the stock, and he got screwed. So he needs the money. He has no choice. That's the problem when you trade in leverage, is you have to sell your gems as a source of funds when the leverage goes against you. So that's why we avoid leverage, and we suggest that you do as well. And that's why you've never seen Buffett panic selling out of his biggest positions in 7-8 decades, because he never fell into that trap that Masayoshi-san did. Masi said he was ashamed. He should be, but he'll be back, and he'll be back bigger, better, and stronger. He's a smart guy. He just got caught up in the frenzy. When people are throwing free money at you, it's hard to say no. And but I can be pretty sure that the next time that happens, he won't be taking it. So, okay. Brendan Ahern does a good job explaining this. He's the guy who runs KWeb. He says that basically SoftBank wrote or sold an in-the-money call to investment banks, allowing the company to collect the proceeds and book a $34 billion gain. The banks would hedge themselves as they effectively sold the shares in the market. The key is that SoftBank said they wouldn't do this again, alleviating the risk of more shares being sold, i.e. an overhang on the stock. So while everyone thinks the sales are coming, it looks like these are settling out now, and he's down to 14.6% from 23.7%, and that could explain the weakness in the past 3 months. The banks hedging out and selling the stock against the options that were out there. This is similar but different to what's happening in Tencent, as Prosus keeps selling their shares, but they've given no guidance on when it will end. Prosus owns a bunch of Tencent. They're selling the Tencent shares to buy back their own stock. Probably a dumb idea. I think Tencent's a much better business than Prosus. But leaving that aside, that's the overhang, and it's an unlimited overhang as it relates to Tencent. Whereas with Alibaba, it's quantified, and it may in fact be in the rear view mirror unless more of Masa's stuff blows up. But that's just why it's like, why isn't the stock going up? Well, there's your answer. So it's given us a couple more opportunities to increase size. But at some point that ends, and when these things turn, they come all at once, just like we saw with Cooper Standard and like we're seeing with biotech. Biden cautious on China tariffs after Pelosi trip. So, Pelosi did her final hoorah, created a lot of trouble, but that's now going to limit what they can do on tariffs and curbing inflation ahead of the election. So we'll see if they go ahead and do it anyway, but Pelosi certainly didn't help on that front. The bull market in biotech is still going strong. I find this comical because, a few weeks ago, you couldn't give away biotech stocks. Now they're calling it a bull market because it's up 40-50% off the lows. It literally hasn't even started. A few more articles like this will probably be up another 10 or 15%. Everyone will, panic chase in, and then we'll get a trapdoor for 20% before we move higher for the long-term move. Get ready for more merger mania in the pharma sector for the rest of the year. Pfizer agrees to buy Global Blood Therapeutics at a deal valued at $5.4 billion. That was another one. Again, that was part of our three-pronged thesis. One was the valuations were at multi-decade lows. We've gone through a million times. Two was animal spirits will come back. That's happened in the last 2 months, now close to a dozen multi-billion-dollar deals, and it's just getting started. And three, drug approvals would start to come in more regularly now that the FDA shifted its focus from COVID to regular drug approvals, and the drug companies could actually get trials done because people were willing to come in and do the trials now that COVID's basically in the rearview mirror. The article of the week, a ceiling system stock market and sentiment results. We go through on June 7th is when we put out the thesis publicly on Fox Business. June 9th, we went into the detailed thesis on the VideoCast number 138. You can look that up on YouTube. Hedge Fund Tips with Tom Hayes, episode 138. The stock is now up 83.4% 4.1 since reporting last Thursday. I think it's up another, call it 90% today. I think it was at 10.50 today or something like that. So this thing is just taken off. And we go through all of this. The other thing that we said, we put this out on Twitter after the big rally on Friday. I said we had a great start on Friday. None of the catalysts outlined in our thesis are manifested yet. The two big catalysts being the refinancing and the chips flowing in aggressively. They're starting to flow in as of the last 4 weeks of Q2 and have continued through July. So that's all good news. This is a long-term play for us and one that we should continue to expect both upside volatility like we saw on Friday and downside volatility. And I go into this in the segment I'm going to put on in just a minute. And also with Mitch Hawk, we go through all of these deals. Number 1 in sealing systems, 2 in fuel and brake delivery, 3 in fluid transfer, etc. We go through the semiconductors. We go through the industry trends. We go through the credit markets. We go through their capital structure and some of the guidance from management on the earnings call. In terms of our balance sheet last month, we announced that we hired Goldman Sachs as our financial advisor to assist us in the process of refinancing a portion of our debt, and that process is ongoing. We are in discussions with certain investors, and we believe the actions we have taken to improve our financial performance and maintain the liquidity will allow us to get the refinancing done. Beyond that, we can't provide any further details at the time, which implies they're in deep discussions, which is good, because if that catalyst happens, you got a $20, $25 stock, and then you just sit tight for 3 or 5 years until they get back to normalized EBITDA. Their guidance is still 9% CAGR on the top line, which implies $3.4 billion of revenues in 2025 at double-digit EBITDA, 10% EBITDA margin. You're looking at $340 million of EBITDA, probably a lot more. $8 to $9 a share in EPS at a 10 to 20 times multiple. So a serious multi-bagger. You need only look back to 2016 to 2017 when they were doing 3.4 billion top line. They had about 400 to 450 million of EBITDA, much greater than 10% EBITDA margins, and was earning about $7.75 to $8 a share and traded up to $146. So stocks don't revert to the mean, just as they overshoot in despondency on the downside. $3.66 a couple of months ago. They overshoot in euphoria on the upside. $146 in 2018. So going to sentiment here before we move on to the first clip. The fear and greed was neutral this week, and the active investment managers were only up to 55% equity, so they still have to chase continued good news, and that's why you see this rip your face off rally today. Managers don't know what to do. They've been sitting on their hands since June, not believing it after they sold in the hole, and now they are in trouble, and they're trying to buy the laggards to try to salvage anything of a year after missing the whole thing. It's unfortunately they weren't on our podcast VideoCast distribution list. So pass it on to them, and we'll be happy to do our best each week. No one gets everything right, but we think we've navigated this pretty decently in the last couple of months. So with that aside, we're going to turn now to the detailed explanation and update on Cooper Standard from the Money Show. It's only a segment of what I did on the Money Show. If you want the whole thing, you know where to find that. And then we'll be back shortly. The first kind of benefiting from extreme play we're going to talk about is a current one. Historically, I've talked about ones that we've done over the years. We're going to start with one that we're in right now that's just getting started. And then we'll go through some of the historic so you can get a sense of how we think about things. But Cooper Standard is a microcap now company. It's a leverage play on the automotive semiconductor recovery and the high yield credit markets reopening. If you note here, you can see that basically the credit markets closed over the summer in July. So in January, all these banks were doing LBO deals. Now they're stuck with $80 billion of debt as the credit markets seized up. That's the bad news. The good news is this part is the most important chart in the markets right now. High yield credit spreads have been coming in dramatically in the last 3 or 4 weeks, probably about 120, 125 basis points now. We think this trend will persist into the fall. The credit markets will reopen. And in the case of Cooper Standard, They've got $320 million due at the end of next year. They will be able to refinance that, in our view, and in the view of management, which had their earnings call on Friday. On their call on Friday, they reported earnings on Thursday, which we're going to talk about. But the idea emanated from Charlie Munger's purchase of Tenneco during 2021 to 2023. And what he said in an interview was for the Daily Journal, which he owns. He said, "I've read Barron's for 50 years, the famous publication. And in 50 years, I found one investment opportunity in Barron's, out of which I made about $80 million. He put about $10 million in for almost no risk. I took the $80 million profit and gave it to Lilu, who turned it into $400 or $500 million. So I've made $400 or $500 million out of reading Barron's for 50 years and following one idea. I didn't have a lot of ideas. I find that I don't find them that easily, but I pounce on them when I do." And if you look at Tenneco's long-term chart, it's very similar to Cooper Standard. These things have huge operating leverage, but when the OEMs, the big producers like GM and Ford, fall on tough times or production slips, they get hit with leverage on the downside and they get hit with leverage on the upside. So in the case of Tenneco, the stock had fallen from $47 in 1997 to about $1.28. I think Munger was buying it at $1.51. He sold out of the stock at about $15. It subsequently went to $35. And then in the great financial crisis, it dropped down again below $1 from 35 to $1, then back up to $65. And most recently in the pandemic, it dropped down to $2. And it was recently bought out by Apollo Group for $20, which I thought was grand larceny because they're stealing about $40 of upside from the shareholders, but somehow the board voted yes. So we think we could see a similar situation with Cooper Standard. It's the same type of operating leverage, and we're pretty excited about it. So at the time Charlie Munger bought Tenneco, had about 40 million shares, a market cap of 80 million, and an enterprise value of 1.6. To put that in perspective, we own a meaningful percentage of the company right now in about the mid $5 range, between $5 and $6 across accounts. And the enterprise value about $1 billion. The market cap got down to 50 million. This was a $2.5 billion company just a few years ago. We think we're going to see those days again as we look 2, 3, 4 years out. We'll talk about the plan to get there. And the bonds, by the way, are trading at a similar way as the bonds were for Tenneco when Munger bought it. He bought the bonds, they were yielding 35%. When we started buying the equity, the bonds were at the unsecured bonds were at trading at about 40 cents on the dollar. Now they're up to about 50, I think 51, 54 spread. The senior secured are trading at a premium to par. So that's that. So we put out this thesis, and the reason I mentioned hedgefundtips.com, we not only put out this thesis publicly on Fox Business on June 7th on the Clayman Countdown, which you can go to YouTube and just search Hedge Fund Tips. All of our media will come up. You can see the June 7th video when we initially launched it, but also in Hedge Fund Tips with Tom Hayes, the VideoCast number 138 on June 9th. So you can go ahead and look that up also in YouTube. So this was a $146 stock, as I said, about a $2.5 billion market cap when auto production was at its peak in 2017 to 2018 period. It's gone from a $146 stock to a $3.53 stock. We started buying the sixes. We bought down lower in the fours, and we've got a mid $5 basis. The market cap from 2.5 billion to 50 million. Now I think it's about 150 million. It was up 69.58%, by the way, on Friday after reporting earnings because they went cash flow positive. So the stock shot up to $8.53. It's now up another 15% since then. It's about $9.73. So many of you are sitting there thinking, well, thanks, but I missed it. I didn't know about your podcast. I don't watch you on Fox Business. How would I ever have taken advantage? Well, one, if you were an investor with me, you would have taken advantage. But two, we think there's a tremendous amount of upside. And we do think that over the next 3 to 5 years, this thing can revert back to a $2.5 billion market cap. They were, doing 3.6 billion of top line in 2017 with a double-digit EBITDA margin, earning about $8 a share. And if you put a little math on that, the stock is traded between 10 to 20 times earnings over its history. So you could really have a multi-bagger over the next 3 to 5 years, provided they can get over the hump. The key thing here, number one, this is opinion, not advice. But the key is going to be that operating leverage, getting the refinancing done this fall or sometime before November of 2023. And number two, this is all predicated on the chips starting to flow in. And as we heard from Ford and GM, as they reiterated their guidance for the full year, the last 4 weeks of the second quarter after the China shutdowns were over, those chips started flowing in. And what we're seeing is in July, the same is true. We also got that confirmed from watching the semiconductor companies. But want to point to something that I put out on Twitter after the stock jumped 69% on Friday over the weekend. And my Twitter handle is @HedgeFundTips. You can look it up. And I said, with CPS up 69.5% today, many have reached out asking me for the original thesis I published in June on the VideoCast. You can find it here. As I said, that was episode 138. One thing to keep in mind on CPS, while we had a great start on Friday, none of the catalysts outlined in our original thesis have manifested yet. So one would be the refinancing gets done, the credit markets open, they're loosening up, right? Credit markets are loosening up, but they're not fully open yet. And two is those chips continue to come and the production continues to come from their big customers like Ford, like GM, which they both guided in their earnings call that they were affirming full year production guidance despite the huge setback in Q2. But in the near term, this is a long-term play for us, and one should continue to expect both upside volatility like we saw on Friday and downside volatility. This thing could very easily be a $5 stock 2 weeks from now if credit markets tighten, and et cetera. This is just the normal part of the process. The problem with buying a stock down more than 90% is it can go down another 90% before you get the multi-bagger. And as I always say on my VideoCast, they don't give away multi-baggers for free. They're earned, okay? So you're taking a calculated risk. It can certainly be a donut hole, but this is what we specialize in, dealing with these situations when the baby's getting thrown out with the bathwater. No one can see a light at the end of the tunnel. But the fact of the matter is the demand is pent up for the last 2 years with the OEMs, and we're starting to see. Take a look here at domestic auto inventories. This is not just at low levels. This is at historically low levels, worse than the great financial crisis, worse than Munger bought Tenneco here. But you can see this is a regular cycle. So this is the estimated worldwide motor vehicle production from 2000 to last year. You can see the dip here when Munger bought Tenneco. You can see it during the great financial crisis. You can see it during the great pandemic. And it's just a regular pattern. It dips and then it recovers. It dips and then it recovers. And if you look here at the IHS industry survey, they're expecting it to get back well above 2017 levels over the next few years. And Cooper Standard has guided that while IHS is projecting 5.9% compound annual growth rate of vehicle production, Cooper Standard is projecting total sales growth of 9% compound annual growth rate over that period. And that's what gets us to $3.4 billion with double-digit EBITDA margins. The stock could be earning $8, $9 a share, 10, 20 times multiple, depending on the sentiment at the moment. But you do the math, the stock's trading at $9 now. You could really have a serious multi-bagger in our view. The downside is they don't get refinanced for some reason, and it's a donut hole. But the likelihood, seeing them go cash flow positive in a tough quarter in Q2, they affirmed their guidance for the rest of the year that they're going to do 50 to 60 million of EBITDA, which means they're going to be averaging, $30 million quarters for the next 2 quarters. And in that context, when you don't need the money, everyone wants to give you the money. And I think the same will be true with Cooper Standard. The other thing, and this is just to give you a sense of how we look at things, top down, bottom up. You look at the average age of cars on the road is, much older than it's ever been historically. Cars are 13.1 years. Light trucks are 11.6 years, and the average is 12.2 years. So there's a lot of different opportunity there. The other thing, a couple key facts about them: they are number one globally in sealing systems. They have a special material called Fortrex, which you can go to their website and learn about that. So that's kind of a moat in the business. Most people look at auto parts as a commodity, but they do have special technologies. The fuel and brake delivery systems, they are number two globally. And number three, the fluid transfer systems, they're number three globally. And what initially, when I looked at this, because I like to look at distress, and what I think separates it a little bit from Tenneco is I said, well, what happens if we really do accelerate in EVs? EVs don't have that many parts, or they're going to go out of business. And the answer is just the opposite. So they make about $155 a car right now on internal combustion engines. They do about 8 parts, you can see here, as it relates to powertrain thermal management. When that goes to hybrid, it's 28 part numbers. And when it goes to battery electric vehicles, it's actually 20 part numbers. On average, they make 20% more for EVs than they do for ICEs or internal combustion. So the future is very bright. If nothing happens with EVs, our thesis is intact. If EVs really accelerate as people think that they will, then we make more money than our base case, which is always a good thing. Just to confirm, not just what GM and what Ford and what some of the other OEMs were talking about, the semiconductors all had one thing in common. Consumer demand for electronics and PCs has gone down. For video gaming, we saw from NVIDIA recently, has gone down. For handsets, has gone down. But guess what's gone up through the roof is auto semiconductor demand is 2-year backlog, and industrial and Internet of Things demand has gone up. And as a result, while all these companies guided down on their electronics business, they guided up on their auto chip business. So Taiwan Semiconductor was up 14% year on year in spite of the China shutdown. NXPI auto chip business up 36% year on year. These companies just reported. Texas Instrument auto chips rose by 20% year on year. Qualcomm chips grew by 38%. And why that's important to Cooper Standard is it means the chips are finally getting produced, because some of that excess capacity from the slack demand on consumer electronics is now being allocated to auto chips. Some of the double orders are being canceled, and the chips are actually getting to the OEMs. And that's all Cooper Standard needs to benefit from their operating leverage, is to see the 100,000 cars that GM referenced that were in parking lots that they couldn't ship and book as revenue in Q2 because there were no chips. Now those chips are coming in. So that's going to be 100,000 cars and a lot more cars moving forward. And being the number one in sealing systems, 2 in fluid and brake delivery, and 3 in fluid transfer, all they need is those chips to flow. Cars will be delivered, and these dealer inventories will start to pick up to more normalized levels. Maybe never back to 1994 levels, but they're selling, and they're selling at higher margin, and that's going to continue. And for those people saying, well, people won't buy cars because rates are going up, just turn on the TV. I saw Cadillac today had 2.1% APR financing for the next 24 months on their 3 new Cadillac SUVs. So there's a lot to do there. Moving right along, they have their top 10 vehicle platforms. The Ford F-150, that's kind of popular in the United States. The Ram 1500, Chevy Silverado, Buick Envision, et cetera. So their top 10 platforms account for 40% of planned 2022 revenue. So we've got that. And then moving right along, we also see that Jeff Edwards, in the conference call just last week, he said, we began to see some improvement in global market conditions and production levels in the final 4 weeks of the quarter, with China production coming back online, European markets and operations beginning to stabilize from the Ukraine war-related disruptions, and increasing inflation recoveries from our customers. They've renegotiated a lot of the contracts to get compensated for that. We saw adjusted EBITDA margins and cash flow turn positive in June, with further improvements in global production volume expected for the remainder of the year, combined with continuing cost reduction initiatives and anticipated incremental positive impact from our enhanced commercial agreements. We continue to expect to deliver full year adjusted EBITDA in line with our original guidance, which was $50 to $60 million. They're at negative 7.5 now, give or take. So that means, you'll be seeing on average 30 million EBITDA per quarter. And in that case, they in theory, with their cash, they've got $405 million, $250 million of cash, $150 million undrawn ABL lending facility. So $400 million of liquidity. They get to cash flow positive, generating $30-40 million a quarter in EBITDA. They technically don't even need to refinance, but when you don't need it, everyone's begging to do it. And with that 9% compound annual growth rate, sales growth over the next few years, that implies $3.4 billion of revenue for 2025. Their guidance this year, the mid-range is $2.6 billion at 10% EBITDA margin, or double digit, as they say, and double digit return on invested capital. You're looking at $350-400 million of EBITDA, $8 to $9 a share of earnings, 10 to 20 times multiple, and that's how we get to the multi-bagger. So these are the kind of things we look at. If you look at 2016, 2017 numbers, their revenues were right in that range, 3.4, 3.6, and they were earning $7.75, $8 a share, and you had $146 stock. Why? Because things never revert to the mean. Just as the stock should have never hit $3.50 in complete sentiment despondency, there's no basis for it ever trading at that level. There's no basis for it ever trading at $146. But just as we're seeing currently overshoots on the downside of late, we will see overshoots on the upside as we look 3 to 5 years out. And that can be a tremendous opportunity. So that's our current one, and that's we find is always most interesting to people. Okay, well, now that you've heard that, we're going to flip over to our discussion on the general market outlook with Mitch. This was on Monday, 2 days before the inflation prints. Check it out here.
All right, let's go ahead. Let's bring on Thomas Hayes. How we doing? Welcome back.
It's good doing great, Mitch. Glad to be here, Mitch. Thanks for having me.
Yeah, excited. I just saw something hit the tape, so might as well just ask you about what do you think about it, Thomas? So I just saw right now Boeing's Dreamliner's deliveries to resume in the coming days. It's, of course, coming from the FAA. How do you feel this will affect Boeing? I know we've had some recent delivery mentions, but it seems like this is a really good outlook for Boeing here.
Yeah, I love this type of headline, Mitch, because Boeing has been a chronic disappointer for the last year and a half. I mean, it's just been tape bomb after tape bomb, mismanagement after mismanagement. And what I like about the stock here, Mitch, is the fact that no one's paying attention to it anymore. Everyone's been burned on Boeing. They've given up on the stock. And now that good news is actually coming out and the stock is silently moving up, you hear no one really talking about it other than guys like you who are paying attention to everything. And I think it's a sleeper that could do very well over the next 12 to 18 months. So good to see this good news, but no one's paying attention, and that creates opportunity for smart value players.
Definitely. It's been hanging on too. I would think that it was going to pull back, but it just hung on to this trend, this recent trend. So it's going to be a fun stock to keep on watching, especially if you hear more and more mentions of deliveries of that 787 Dreamliners that has been halted for 2 years. I mean, it's been a while since we've heard that kind of get the resume. And I think everyone was watching the FAA if that news was actually going to hit the tape. So there we have it. Let's get out of that. Let's talk a little bit about, I'm going to play a fun game with you. Let's do over under on the CPI estimate, 8.7, of course, the estimate. And the next question following that would be, how would the markets, you think, react towards that if it's over or under?
I think it's going to be under. And if you look at the Cleveland Fed, they have some real-time inflation metrics. It's actually pointing to 27 basis points up year on year for July, which would be about 3.4% annualized. If that's the case, that's going to take the market by storm. And it may, in fact, negate what we saw from Friday. That jobs report came out super, super hot and kind of put the Fed pivot narrative on the back burner in the short term, with that many jobs created and the unemployment rate at 3.5. Everyone had been kind of positioning for a pivot in September. That took that off the table. But if you do see the under, like I'm talking about here, it may bring that back on the table. So we're pretty optimistic looking at the Cleveland Fed data. We know that commodities work on a lagged basis. They rolled over in June. You're starting to see a little bit of in the cash register. Even Elon Musk said we're past peak inflation. He's seeing it in component parts for his cars. So that would be a very pleasant surprise and potentially offset the good news, bad news of Friday.
Yeah, now if we do see it come in under, all right, so the scenarios hit, let's say, I don't know, well, let's say 8%. How will the Fed be handcuffed here, or will they not be handcuffed here if they start seeing inflation turn around? Of course, we saw the increase in the jobs number. That's why I think they are a little bit handcuffed here, because there's a strong labor market, but of course, their main focus was inflation, and they're starting to see it trickle down. What will they be left to do?
Well, if it comes in under, that gives them the ability to raise less than anticipated, which is what the market would like to see with inflation coming down. So, the fact, what you see a lot from the Fed at this moment is jawboning more than action. And the reason that they're doing jawboning, and no one's really talking about it, is the fact that our debt to GDP ratio is 125. They're limited in how high they can go without making the debt servicing unsustainable. So they've been doing a great job of talking inflation down, talking demand down, slowing the economy down. But if you think about it, Fed funds rate at 225, 250, that's where we peaked at the last tightening cycle in 2019. So, without what we saw on Friday, it wouldn't have surprised me if we saw a pivot in Jackson Hole. With that strong jobs report, it's probably going to be delayed until September. Maybe we get one more hike. But the key, as you said, will be the CPI and the PPI numbers this week. And we're definitely taking the under. They've been stubbornly high, but I think on a lag basis, we're now going to see it. The other thing that's critically important as it relates to inflation, everyone always looks at energy and commodities, but it's used car prices and new car prices. They've been unnaturally high because the demand exceeded supply, and that was largely a function of a shortage of auto chips. Well, you spoke to the NVIDIA pre-announcement that their earnings were going to be weak on the basis of the consumer side, video gaming, crypto mining, etc. We've seen that across the board, whether you're talking about Taiwan Semiconductor, NXPI, Texas Instruments, Qualcomm. They say the consumer and the consumer electronics side is all slipping. PC demand is slipping. But guess what that's created? They've been able to reallocate capacity to auto chips, and that demand is backlogged for 2 years. New car demand is backlogged for 2 years. And as those chips continue to roll in, which all the auto suppliers spoke to on their calls, they started to roll in the last 4 weeks of June after the China shutdown was done. Ford maintained their full year production guidance and earnings guidance. GM maintained their full year production guidance despite having such a horrible Q2. So as those chips roll in and you see the massive new car production and those 100,000 cars that GM couldn't get off the lot because they didn't have chips now getting onto the lot, that's going to bring down used car prices dramatically as a glut of new cars come online. And that's going to bring down inflation dramatically. So I'm less worried about inflation than most, albeit we just passed a big spending bill in the Senate. I know it's called tax and spending, but we know what it actually is. So the market's kind of trying to digest that if that gets passed in the House, which it likely will. But all in all, inflation, I think, certainly has peaked, and it would be nice to see it show up in the numbers this month. Optimistically, and certainly by next month on a lag basis, but I'm definitely going to take the under.
All right, now what opportunities are you seeing arising from the passing of the Climate Inflation Reduction Act? Is there any opportunities that are rising? I know that JP Morgan coming out with that call on First Solar about potential 20% upside. Do you see any opportunities coming out of this bill?
Well, I think the buybacks are going to be accelerated. I think companies are going to they've got record cash on the balance sheets. They're going to now look to the tax kicking in 2023. and all the buybacks they have slated in their authorizations for 2022 and 2023, I think we're going to see a lot of that accelerated into the end of 2022 so they can do it without the tax, and that's going to create a natural bid for the market. I think the other thing you saw today on the news was biotech was up big this morning. It's cooled with the market since, but it's still positive on the day. And people were scared about this drug pricing provision. And the good news is it's less punitive than anticipated in that it doesn't go into effect till 2026. It only goes into effect on a small number of drugs starting 4 years from now, and on no drugs in the first 13 years. So it's only off-patent drugs that this could potentially affect 4 years out. And I think the drug stocks and the biotech stocks got bid, and they've continued to follow through. I know we've been on your show many times since May, which was the lows, saying biotech, biotech, biotech. Well, now you've got the XBI some 40% off the lows since June. And we think if you look out over the next year and a half plus, it's just the beginning. You've seen animal spirits with a lot of deals, even one deal announced this morning, Pfizer buying Global Blood Therapeutics this morning, another multi-billion-dollar deal. That's, we're approaching a couple of dozen, and just in the last 2 months, animal spirits are back. A lot of drug approvals now coming through the pipe as the FDA takes its focus off of COVID and puts it back on drug approvals. The trials are back in effect now with people willing to participate in the trials. So those are some things we look at. But back to the point about auto suppliers, which I know we've talked about on your show as well, this was wholly dependent on the chips coming in because the demand for new cars has been pent up now for a year and a half. They just haven't been able to supply it. I think there's going to be a huge opportunity in our third largest holding, which we may have mentioned with you in the past month or so, was Cooper Standard. They reported on Friday they were up 69.83% on Friday. That's a long-term play. The reason it was so beaten down was they've got some debt they have to refinance before the end of the year, which we think that'll get done. Management said as much on Friday's call. And that stock has followed through today, which was nice to see after such a big move on Friday. But if you look out 3 to 5 years as they get back to normalized EBITDA, this could be a many multi-bagger in our view.
Something definitely I want to keep an eye out is how that reports on the CPI. And so I'll keep watching exactly what you're mentioning there. Do we start seeing that shift? And will we start seeing some kind of new sales really start getting off the line? Because a lot of that issue has just been, like you said, not having the chips. And now if we are going to get that kind of push in the chips because, of course, the turning away from the gaming, that could definitely drive some of these stocks. Now, one area that I have to ask you in is, of course, is oil. Are you bullish or bearish oil stocks from here? It's been a tough call. I would like to see how you look at it.
Yeah, well, we were pound the table bulls on oil stocks in 2020. We sold them off earlier this year in the Russia war strength, and maybe a couple of months too early, but that was a huge trade for us over a year and a half. Made a lot of money there. And now looking forward, we've been less interested. We said the trapdoor was going to open sometime in the middle of the year. All these people chasing oil who hated it in 2020, loved it in 2022 when it was at the top. The trapdoor was coming, and sure enough, it is. And the trapdoor has knocked a lot of wind out of these stocks. So I'm not an aggressive buyer. The other thing that no one's really paying attention to is the rig count. That rig count now is 670 or so, 674. I'm sorry, 764. That's down from 790 pre-pandemic, but it's up from 244 at the pandemic trough. So that is a big factor that while everyone's looking to beg Saudi Arabia to pump more oil, we've got a lot coming online in the United States, and I don't think people are fully accounting for that moving forward. So I'd say I'm agnostic here. I don't chase things that are up. I buy things when they're out of favor, and then I wait for everyone to get interested in them, and I lay it off. So we just do that over and over. Talk to me about some things that no one loves, and I'm interested.
There you go. There you guys have it. Something to keep on watch, the U.S. rig count. I appreciate you, like always, Thomas, bringing a little bit of extra. Now, the last thing I'll leave you off to is there any kind of plays that you're watching to kind of continue moving? Is there any opportunities you like right now?
Yeah, I certainly think you want to keep your eyes on the auto suppliers. Now that the chips are coming in, they make their money when OEMs, Ford, GM, et cetera, ship cars. And now that they're going to start shipping like crazy with the chips coming in, the auto suppliers have huge operating leverage. They've been kind of in the bullpen. Now they're on the mound and they're going to start throwing strikes left and right. Pay attention there. Biotech is going to continue to follow through. And I know, China tech, I'm like a broken record. It hasn't worked yet, but that's going to be a trade. The number one thing you need to see if you're skeptical about China tech, just watch the US dollar. If you do nothing else, if that US dollar continues to weaken into year end, you want to be in emerging markets, and China is the heaviest weight in emerging markets. So if you don't like China, just wait tight until you see that dollar start to crack, and that'll be your signal to maybe get some exposure.
All right, we'll see what happens. I know a lot of people are thinking about China, but probably in another sense. They're thinking about worrying here, and you're completely giving us another side to keep an eye out. Appreciate that. Like always, Thomas Hayes here, chairman and managing member of Capitol Hill. We'll definitely have you back on.
Thanks so much, Mitch. Okay, and to wrap it up, we're going to take a look at earnings. While everyone was calling for a 20% revision in earnings, we've had just about a 2% revision in earnings, down to about 245 for 2023 versus 250 just a few weeks ago. And 244.93 and 227 for this year, down from 230. So the rumors of the death of equities were greatly exaggerated. And now we'll just go through a couple Ask Me Anything questions and wrap it up until next week. Kashganja asked, Tom, did your view on Intel change after the earnings and outlook they gave? Greetings, Bart. No, absolutely not. We could care less what happens in the next 3 quarters. We're playing the 3 to 5 year turnaround. We think this is an $80, $90 stock over the next few years. Not our best idea. It's a tiny position for us, but we like it and we want to participate. Okay, Jason Patel. Tom, huge fan of your content, thinking about various investments, especially in China. I too am very bullish on China and coming out of a cycle bottom here in the near term. Tailwind to QA. Two questions, if you're willing to share any sentiment and thoughts. I'm a novice. Okay. So is additional QE from China contingent upon Federal Reserve and European Central Bank getting through their QT, or at least the majority of it? No. When I bring up China investment thesis, some of which are in the hedge fund, India pops up in the discussion. What do you think? Well, I said that you should listen to the Indonesia Investment Conference. I think Indonesia and India are going to be the 2 best investment opportunities in emerging markets for the next 10 years, the fastest growth in terms of like broad buying countries, buying companies. We love Alibaba. We think that's going to be a monster. But they're also growing very aggressively in Southeast Asia, and that's how we're participating in it. So definitely, Jason, go ahead and listen to that Indonesia Investment Conference. We talk about India, we talk about Indonesia, and the growth and the demographics, etc. It's very detailed. It's very good. Mark Messer, one of the lessons I learned from you is patience paid off. Totally changed my way of investing. Mark, I'm very glad to hear that. It hasn't even started yet. So, this could be a $5 stock tomorrow before it's an $80 stock. So don't worry about the short-term volatility. But yes, patience does pay off. That's how you get rich. And keep hanging in there. Good job. All right, last one from Drew. Let's see. Oh, okay. So here's one from Roy Baines asking about Progressive Holdings, PRG. I like it. Just did a quick look. I think it's fine. And then Drew, thanks for your compelling weekly market insights. It's my financial highlight of the week by a country mile. Looking forward to becoming a member very soon. After focusing on the U.S. this year and given the recent excellent AMA questions on ASOS, I've been looking at the following beaten down UK stocks, wondering your thoughts. Rolls-Royce, we like it, we own it. ASOS, I gave my thoughts on that. And then following beaten down stocks have also been rumored for takeovers. Rumors for takeovers are BS. It's usually just someone that's bagged in the stock, that was on leverage, that needs to get out. They pass off the rumors. They hope it pops up so they can dump out of their stock and get enough liquidity to get cash. Sometimes they actually happen, but usually it's never buy a stock on that basis. Buy the stock because you want to own it 5 years from now, regardless of the underlying price. So THG. All right. Made.com, business model under pressure. I don't like these new businesses. There's not enough long-term data. Let's see, the Hanover Group. It looks like Progressive, actually. So it's fine. Fever Tree. I mean, this feels like a fad. This is like, it's a really popular drink mix. It'll probably get bought out. Actually, that one probably will get taken out. Although their margins are probably compressing. I'm not familiar with Fever Tree. Let's see. FVR. Fever Tree Drinks. All right, let's take a look here real quickly. That's interesting. Let's see what's happening with the financials. Okay, they're growing top line. Their gross margins are declining, but that's the gross margins are declining. I mean, they're from 55% down to 42%, so it is deteriorating. That's probably obviously already priced in. Net income has been flat. That's probably priced in. So I think this is kind of a bet. Let's see, return on assets, return on capital. It's halved. It was generating 40% return on capital. It's now at 20%. Return on equity, it's also halved. So, it's a deteriorating business. Let me just see here if their revenues are growing. I mean, their revenues are still growing. I mean, this is one of those, if you want to take a punt, maybe you get a double, maybe you get a takeout. You'd really have to drill down and understand, is the business deteriorating because it's a fad that's over and there are new replacements for these drink mixers? Or is it just because of leftover COVID that the volume hasn't ramped up yet? But, you didn't see that with Diageo. You didn't see it with Constellation. I mean, those things crushed it during COVID. So why is this thing lagging? And you'd have to drill down and do a lot of work. The thing about these podcasts is I'm generally not going to do the work for you. I'm going to point you in the direction of how to think. And if you've watched this long enough, which I know Drew has, and he's been a great and awesome supporter over the months and years, you should be able to drill down and start to do some of this work yourself. Read and listen to all the conference calls for the last 3 or 4 years, pull the financial documents, read the annual reports, and treat it like a business. If you were going to buy a private business, what level of due diligence would you want to do before you put your hard-earned capital into owning a piece of that business and moving forward? So I think you're on to something here. I think you've got a knack. I think you just got to drill down on a couple of these. I'll take a quick look at Made.com. My guess is that it's going to be a newer business, and I'm just going to pass on it out of hand because there's not enough financial data. But let's see what the facts are. Yeah, I mean, this is a 3-year-old business. They're growing revenues. Let's see. Gross margins are declining a little bit, but pretty high. Losing money. Negative EBITDA. Yeah, this is not my cup of tea. I mean, I don't like these type of business. This is just a finger in the wind, hope for the best. Is it going to grow? I don't see what's around corners. I bet on sure things largely, and sometimes there's some exceptions, but this would not be one of them for me. But I think Fever Tree's worth looking at a little deeper. It's not going in the right direction, but there may be an opportunity. Do not buy it on a takeout basis. Buy it on a turnaround basis. And if you listen to the calls and look at the presentations, you can discern whether management's turnaround plan is legit or just finger in the wind, Hail Mary. And other than that, I think we're done. So we'll see you next week, same time, same place. Thanks for tuning in. In the meantime, make it a great one. Bye for now.